The Nifty and Sensex end with cuts for the second straight week, but midcaps have outperformed. Auto and pharma stocks have fallen the most. On today's edition of Editors Roundtable, we take stock of the week gone by, decode India's QIP fundraising spree, and put the spotlight on China's big equity rally. I'm Surabhi Upadhyay, and with me are editors Nigel D'Souza as well as Nimesh Shah. Guys, finally, thank God it's Friday. But I guess for the market, it's a bit of mixed feeling. We haven't fallen, at least the falling has stopped. But Friday, kind of put a lid on some of the recovery as well.
Well, it was more of a recovery as well in the broader market stocks. And that was a bit of a relief, Surabhi. Clearly, the kind of carnage we've seen in the broader markets, the mid-cap index down 20, micro-cap down 21, Nifty 50 down 22%. And after that, such a sharp fall, a bit of a respite was also helpful. So a bit of recovery in the broader market stocks this week. That was a kind of a relief. But if you ask me, we're still not out of the woods. So next is going to be crucial. We have an expiry as well, truncated week. So Wednesday we're holding a holiday. So that's a good news. But yeah, I mean, the pain doesn't seem to be over yet. And the overall feedback I'm getting is maybe till mid of March, you might see that pressure in the broader markets because of the leverage selling or whatever you call it. That might continue for the next another couple of weeks.
So maybe some more days of pain ahead, maybe.
Yeah. Well, and normally towards the end of March, we have that tax harvesting as well that we normally see. Since we're going to be looking forward to an India versus Pakistan game, I'll just put it in cricketing parlance. If you're out of form, you could either try to smash it out of the park and maybe lose your wicket. Or maybe you just try to guard your wicket, hold on, maybe don't score too many runs, but at least hold on to your wicket. I would view this week positively in that sense, because at least we didn't give everything away. Yeah. Otherwise, if you look at the stats, last 12 trading sessions were down, 11. So
Absolutely.
12 out of 13 sessions, you're in the red.
At least we managed to save the wicket.
Yeah, indeed. But let's take stock first of, what went on in this week itself. So a quick recap of what went on in the week. The 22,700 mark, well, that got protected yet again. And that's the quintuple low that we're talking about, because 5 times we've gone to that mark and we have not broken that particular mark. So the quintuple low is important. Just take a look at it in the screen. Less than a month, we have gone numerous times to that mark, and we have bounced off that. The markets this week, well, you'll see the Nifty, well, it ended mildly in the red. The positive is the mid and the small cap indices were up close to around 1.5%, and I'll take that positively. Another positive that I saw was select stocks. You have the promoters that are coming in there and chipping in. JSPL, the promoter, bought close to around 0.5% from the open market. Maharashtra Seamless, another smaller company, they bought close to around 0.5%. So promoters coming in there, showing the faith and trying to buy in some stock. Both these two stocks, by the way, had corrected close to around 25 to 30% from the recent peak. And, coming out there and buying close to around 0.5%, that's viewed positively. Besides that, the sector of the week was the metal index. Remember, it got smashed when we were seeing a correction. So pulling back some of those losses, you have the rupee that is relatively weaker. Metal stocks, they actually gain from there because to import your material becomes a little bit more expensive. And all eyes on what the government is going to do, what kind of protection we can see from the government of India with regard to the steel companies, because that has been the big cry out there, and many of them believe that it's in the offing. So metal stocks were the toast, this week itself. And, guys, the markets have been relatively underperforming, a little bit of a jittery. But a couple of positives on the economy perspective, and some of those fundamentals actually are looking better. One factor being, Pankaj Tibrewal in his note that he writes at the end of the quarter, he has said that the Nifty 500 companies, the earnings growth is 8.5%. That's better than quarter one as well as quarter two. So that's one positive. The second factor is, the government capex has started picking up. That's good news. The RBI, they have addressed that deficit that we were seeing with regard to liquidity. The repo cut, you have the OMOs, you have the swaps as well. So that's taking care of that. And lower crude oil prices and well-behaved dollar index, you like that as well. And as most of the notes this week pointed out, that post this correction, and if you're factoring in the earnings growth of around mid-teens in the next 2 years, well, then the Nifty is trading a little bit lower than its long-term averages. So put all this together, market's jittery, but maybe on ground, some of those fundamentals have actually improved.
Okay, well, lots to track, and we have our guest joining us as well. We have Mihir Vora right here with us on Editors Roundtable.
Hi, Mihir.
Hi.
How are you feeling?
Not bad after such a lot of traffic.
I thought you'd say not bad after this kind of market, but okay.
No, I really got stuck in traffic today.
But
so is the traffic worse or is the market worse?
I always prefer the markets to be better.
But Mihir, what's the sense now? We've seen a much needed correction, so to speak. Mid-cap index down 20, small cap down 21, micro cap down, Nifty 50 down 22%. Yeah. What's your sense now? Given the earnings, given that there's a bit of ease of liquidity as well, are we done for the time being, or there is more pain?
I hope we are done for the time, because you mentioned how much the indices are down.
Yeah.
But if you look at the small cap 250 index,
Absolutely.
the median stock was down more than 35%.
Correct.
Even though the average might be 22, 23%.
Correct.
So it's been a quite a sharp, quite a brutal correction over the last 1.5 months. My guess is, all the factors that we talked about, the dollar, FII selling, little bit of cyclical slowdown, government ordering, all those did contribute. But if we are sticking to the 6.6% GDP growth target for FY26, then there is no reason to believe that this is going to sustain for a while. Because if 6.6% happens, then I think we have to be back on the cyclical uptick, and that's what the market should be responding to going forward. So I think the cyclical downturn has been discounted to some extent, to a great extent, I would say. And now if we stick to the 6.5, 6.6 GDP for FY26, then I think valuations are pretty much okay.
So, May, you'll be in the camp, since you spoke about traffic as well, and we're talking about the markets looking better, you would be in the camp that says that fundamentals, actually things are looking much better now in comparison to, say, a couple of weeks ago, because I was looking at even the fast-tag collections. In the month of January and February, it's improved much better. So that's telling you there's a recovery on ground. And we also spoke to an OMC, IOC. They also said that demand is much better in Q4 in comparison to the previous couple of quarters. So fundamentally, things are improving on ground. And in fact, valuations as well are a little bit more comforting. Is that the take you would take?
Absolutely. So, in fact, valuations have more than corrected for the slight deterioration in fundamentals we saw in the previous quarter. This is the quarter ended December. But markets always tend to look ahead. And apart from the data points that you did mention, power demand also seems to have picked up power volumes. So I think, as I said, it was a cyclical downtake. And if we go for a cyclical uptake, then I think valuations are more than compensating for that.
So, Mir, then how will you position now? If you're expecting a cyclical recovery in the overall market economy and plus the earnings as well, and we've seen the correction in many of those sectors and stocks, how would you position now? What are the sectors you would bet on from here?
So I would really take a bet on financials to start with, because this sector has been the worst impacted not only in the recent correction, but actually over 1.5 to 2 years. And because of combination factors, RBI keeping liquidity tight, crackdown on unsecured loans by the RBI again, and the DXY anyway supporting a stronger dollar, leading to FII flows for a long period of time. And FII has maximum exposure in the financial sector because of the MSCI weightage of almost 35-40%. So we have seen the worst of selling as well as liquidity tightening impact on the financial sector. And when I say financials, I'm talking about the big NBFCs and big banks, private sector banks. And that, fortunately, is a big weight in the overall index, whether it's the Nifty 50 or Nifty 500.
Yes.
So I think that's one sector, the big NBFCs and banks to bet on. Again, base case being, we are in for a cyclical recovery. So that should be the first to do well in a cyclical upturn, both because valuations are good and we've seen the deterioration in fundamentals impacting this sector the maximum. Credit growth is the big thing to watch for. We went down from almost 14-15% credit growth to 10%.
Yes.
For a country like India with a nominal GDP growth of 10-11%, like 10% credit growth is like rock bottom, It can't go. If it goes worse, then we are in for trouble.
But that's improved to 12% now.
Exactly.
Yeah.
So hopefully that's a cyclical recovery that we are talking about.
But speaking of course, market action, I guess some of the buzz in terms of fundraising is back. I mean, we're hearing about more IPOs coming to the market. There are some blocks that have started happening. Exactly. So that tells you that people are, slowly warming up. Yeah. So, Nimesh, what are you tracking this week?
Surbhi, given the kind of fall we've seen in the broader markets, I was just looking at the QIP data of last 1 year. In the last 1 year, the India Inc. has raised nearly 1.4 lakh crores via QIP. Okay, and of that, nearly 2/3 of the companies are now trading below the QIP issue price. So that's the startling data. 1.4 lakh crores raised, the value now is close to 1 lakh, which means they're down almost 27%. Having said that, there are some winners, some small winners, but there are a large list of losers as well. I'll first talk about some companies which are still trading above the QIP price, and the most notable name in that is Lloyd Metals. Nigel tracks it very closely. They raised up 1,200 crore QIP, and from there, the stock is up almost 71%. Coforge is another big name, is still up 69% from the QIP price. Likes of Wokhard up 25-26%, Shyam Metalics up 23%, and the likes of PG Electroplast and Polymedica. These are the only few gainers which are still above the QIP issue price. But the list of losers is quite large. As I said, almost 69-70 companies, which is 2/3 of the companies, are actually trading below their issue price, QIP prices. The notable names there is, for the first name is of course Zomato, one of the highest company in terms of fundraising, 8,500 crores that they raised. The stock is still down 8-9% from the QIP price. Adani Energy Solutions, that stock is down 31% from the QIP price. They also raised close to 8,400 crores. Warren Beverages, we all talk about it's a market leader in that space. Still, after the fundraising of 7,500 crore, is down 17%. Godrej Properties, Prestige Estate, the real estate names are down 20-25% from the QIP prices, and PNB is down 8-9%. So this is a broad list of some companies that I've identified. This list only is talking about companies which have raised funds over 1,000 crores. The list is quite large, and there are a lot of smaller companies which are down 20, 30, 40% as well from the QIP price. But I just want to give a couple of things, and then we'll ask Mir as well. See, the good part about it is that because it's a QIP, the funds have come into the company. So what we have to track is three things that the company can use for. One, are they paying off the debt? If they're paying the debt, you will see their impact in the very near future in terms of financials, in terms of bottom line. So that's something to track for. Or they can do a capex, the impact of which will come in the next 3-4 quarters, or they may go for an inorganic acquisition or an inorganic opportunity. Again, that could be a bit of a binary event. But the fact is that the companies are sitting on cash after the money that they've raised by equity. So point is, one need to see whether there could be a kind of a fishing ground for a lot of the fund managers to look at this kind of a data for a potential winners in this list. Mir, coming to you, I just read out the whole list to you. Across sectors, across companies, we've seen a lot of stocks are down below the QIP price. What's your sense? Would you look at this bucket in terms of identifying opportunities in the very near future?
You mean the stocks which have done QIP? Yeah. Of course, definitely. Yeah. Because in most of the cases, it is growth capital. Yeah. Right, and by nature, at least our style is of growth investing. So we do like good companies which raise money for good purposes, for growth. I think that's definitely a space to look at.
One more thing, Mihir, that I wanted to sort of chat about, and this is latest data that came out from the NSE, their market ownership tracker. So we all know, obviously, FPI ownership has been going down. Domestic institutions have been, loading up on the market. By the way, the combined ownership, whether it's through the domestic mutual fund route or the direct route, people buying equities, that combined ownership of Indian individuals has overtaken FPI ownership of the market for the first time since 2006. It tells you about the huge churn that we've seen in the last many months. That's one data point. The other data point that I wanted to talk to you about was a reducing share of promoter ownership. Second consecutive quarter. Even for all NSE listed companies, that number has come down to, I think, just about 50, little over 50%. For the Nifty 50 companies, promoter ownership has now come down to about 49%. So promoters are selling, and Nimesh has been telling us about the selling, non-stop blocks, right, all through 23, 24. Is this at all a cause for concern, or is it okay? Promoters go, some strategics come in, and it doesn't really matter for shareholders. How do you look at it?
I think we've discussed this in the past. Yeah. I'm not too worried.
Okay.
And it is a function of price beyond a point. At a price, some promoters will come and send a bit of stake, probably for personal purpose, buying a flat in,
or bring it back into the equity market, or bring it back into the equity market.
Equity market through their family offices. Yeah. A lot of people are doing that. Yeah. So I don't think it's a cause for worry. I mean, there is a bit of stake sale, but it's not something that I would say they're exiting the business altogether and not doing anything with the money.
Okay.
Sylvie, just to add to your point on the retail ownership at the highest in the many years, the way to look at it is the corporate balance sheet is strong. The only leverage right now in the system is the retail leverage. The bank balance sheets are strong, government balance sheets are strong, corporate balance sheets are strong. And look at the kind of list I read out, right? Almost 1.4 lakh crores was raised by the corporate India. So even their balance sheet is strong in terms of having cash. Yeah. The only leverage in the system right now is the retail participation.
The excessive trading leverage.
And that could be a bit of a scary in the very near term.
Okay, well, we have lots to discuss. Mihir stays on with us. We'll take a very quick break. After the break, I also want to put the spotlight on what's happening with the China market. While we are discussing a slowdown and a fall here, the Chinese market is soaring. So what's going on over there? We'll talk about it after the break. Welcome back. You're with us on Editors Roundtable, and we've been discussing, of course, the consolidation in the local market, the slight revival in the mid-cap arena. But the biggest global story of this week really has been the non-stop rally in the Chinese markets, and more specifically in the Hong Kong Hang Seng. even more than the mainland Chinese market. So what's really going on? Let's put the spotlight on this. Now, the Friday moves first up. This was Friday. A lot of Asian markets were flat to slightly negative or very mild gains. But look at the Hang Seng, 3%. Actually, by the time it ended, the market closed out. This was an intraday market trade that I took. It was almost a 4% move on the Hang Seng. The Nikkei is slightly higher. The Kospi was flat, and the Nifty, we ended down about 0.5%. But it's not a Friday story at all. This story has been in the making since the start of 2025. Look at the huge disparity in the distinction between the Hang Seng, which is up almost 19%, and the Nifty, which is down 4% so far this year. Let's go a little deeper. Like I said, this is more a Hong Kong Hang Seng story right now than a mainland Chinese equity story. So the Hang Seng, like we said, is up about 18.5%, 19%. The mainland indices, the Shanghai Composite in 2025, about 3.3%. The CSI 300 index, about 3.8%. So what's happening with the Hong Kong index? Actually, even if you dive in a little deeper, you'll realize it's the Hang Seng Tech Index that's really caught the investors' imagination. The index is up about 34% so far in 2025. But I tell you what, this is not a story that's just started this year. It's been in the making for the past 6 months or so. Because if you look at the last 1 year gain of the Hang Seng Tech Index, it's almost 70%. What has this index done? It peaked out in Jan 2021 when all the noise around tech entrepreneurs started in China. The peak was 10,300 almost. It crashed to a low of 2,720. And now the recovery, it's a very, very impressive recovery. It's come back to a level of about 5,800, which means the index has doubled from the peak. I mean, the increase is almost 111% from the low, that is. So let's move on and talk about what are the factors that are leading to this. Couple of factors. Number one, DeepSeek. The world is absolutely enchanted with this low-cost AI model that the Chinese are able to make. Then it's not just DeepSeek. There's recovery in Chinese tech earnings as well. Look at Alibaba's numbers. The stock was up 15% in mainland in the Chinese trading on Friday, 8% on Wall Street trading. And it's not just Alibaba. Even stocks like Lenovo have outperformed expectations this quarter. Then, of course, the big event was the Chinese president's meeting with the industry leaders and entrepreneurs, and the fact that Mr. Jack Ma was present in this meeting. That has really, sent a very, very positive signal out there. What did the Chinese president say? Mr. Xi Jinping is now saying that he wants a very open and fair sort of relationship with Chinese industry. No arbitrary seizures or no sudden inspections, which is what we remember, which is what happened immediately after COVID, which is where the big tech crackdown was happening earlier. That seems to be now changing, and there seems to be an olive branch that the government is giving out. Last but not the least, obviously, valuations. Look at China valuations. MSCI China is trading at about 11, 12 times 1 year forward earnings. MSCI India is still trading at almost 20 times. So there's a very clear valuation difference. The question is this the real deal? Or is this another flash in the pan trading tactical rally in China? This is the Hang Seng chart of the last 1 year. The thing is, we've heard this before. We've seen this before. In May, there was a bit of a trading fillip that came through because of stimulus measures. Again, in September, there was a big rally. We thought this is the big China stimulus, but it fizzled out. And now this is the third wave going up. Just to jog your memory, a lot of stimulus measures have been announced by China in the last 1 year, starting with monetary measures. They cut the reserve ratio requirements. They cut the reverse repurchase rate as well. Then there were measures for the property market, and there were measures for the equity market. Some of them were very interesting, easier buybacks, getting a lot of the index funds and ETFs to invest more money, telling Chinese local mutual funds and insurance companies to increase their holding of local stocks. So all this has happened, but the rallies have fizzled out, which is why I'm asking, is this the real deal? Because now you have the tech companies moving higher and all the past 1 year stimulus. So will the dragon really start firing again? Because if that happens, Indian investors will watch very, very carefully, and they will wonder whether this further complicates the issue for us with respect to FPI flows. And that's really the question I want to put to Mihir. Mihir, we were talking about market ownership, and of course, it's domestic investors here. We own the market here. But FPI selling has really broken the markets back. Now, I don't know about selling or not. The fact is, with China doing what it's doing right now, if this continues, do all hopes kind of go out of the window of us getting more foreign money?
See, till about a month and a half ago, I would have said that India versus China was not the thing, in the sense, because we have seen China stimulate its economy many times in the past. But it's never worked to attract flows away from India into China, right? And even in the last quarter of the last year, 2024, we did see big stimulus measures being announced, but that again didn't move the needle that much as far as flows into China are concerned. I think the Chinese tech story has somehow grabbed the attention of FPIs in the last month and a half, and I've been talking to a few fund managers. There is intense action, more so, not so much to be in the tech space, but for the first time they feel that they've been underweight on China for so long that to continue to be underweight might lead to underperformance in the short term. So if you look at the FDI flows, they are still negative.
Sure.
FDI flows into China have collapsed, almost down to zero from $100 billion a year. If you look at the last 3 years, it's virtually down to zero, and there is net outflows of FDI.
But
so the longer-term investors are still looking at China with suspicion, which was the original story. The risk, the geopolitical risk of China being close to business, you never know when some businessmen will go to jail, etc. Those risks remain. So FDI has collapsed, but the tactical guys, the more easy money, which is easy to move around, which is the FPI money, has probably moved a bit to China tactically.
The Bank of America Securities actually said that this could be a first pivot from just being a tactical trade to being a tactical market, a trading market, to being an investable market. Right. I don't know. And if that shift happens again...
Maybe just to take this point forward, one of the counter-argument to this whole China doing well is because of the MSCI, the way the composition is, and the fact that India is a part of the MSCI, there is no China-dated fund or India-dated fund. It's an EM fund. So if the fund flows into EM for a China reason, would India be also a beneficiary of that?
Certainly, but that needs to have substantial money moving into EM, which is still not happening because the dollar has done so well. The Nasdaq is also under. So we have to compete with a lot of things, including now China's tech.
So coming back to, like, for instance, you said financials, and that's a theme that you like.
Yes.
The problem is financial stocks move higher when that big FPI pipe opens up again.
Correct.
Do you think financials can do well even without, the FPIs returning?
They should, because ultimately in the medium term or long term, obviously valuations and growth equation, that's what drives the stocks. But we also need to realize that not only have FIs sold in India, but they are also still retaining the net short positions in the Nifty futures and some of the stock futures. So if that becomes a trigger, and for me, the biggest trigger will be stability of the dollar, and which we have now started seeing in the last couple of weeks. DXY from September to September 24 to now moved from 100 to 110. It was a massive move against all the currencies, which, basically it was US dollar and nothing else versus everything else, so to say. But now we have seen the last 3 weeks, it has come down from 110 to 106, 6.5. So my view is that even if it stabilizes at 106, 6.5, that scare or that horde of money which was going to rushing back to the US may stop, and that probably is enough. You don't even need the rupee to go back to 85.
We can have a breather at least. Like this week, we can just holding our own would be perhaps something positive that we can take.
Absolutely. So I guess take a breather. Watch the match over the weekend, enjoy the India-Pakistan match on Sunday, and come back fresh on Monday morning.
That's very, very good advice, Nimesh. I'm definitely going to take that for sure. Mihir, thank you so much for dropping by and giving us perspective on the market. Well, with that, we're out of time. It's curtains on this edition of Editors Roundtable. Stay tuned to CNBC TV 18. News and updates continue.